Bharat Shah of ASK Group believes that equities is the best asset class for long-term wealth creation. He's also happy with the current turmoil because, in his words, it differentiates the men from the boys and provides for more future discipline. I began this conversation by asking him about investing in equities. Listen.
No other asset class can create long-term value of the kind that equity as an asset class can and does. And that is because investing in equity is nothing but owning businesses. And ultimately, as we all know, that it is only the businesses which create greatest economic value. Owning fixed deposits of the banks don't make you wealthy. They just can give you given limited returns. Real estate, at the end of the day, is an article of consumption, a factor of cost of production, and therefore returns cannot exceed that of the returns created by the business. And the other asset, which is gold or the bullion, is not even in any asset class in any meaningful definition. So equity is the only asset class which can create not only outsize potential to create value, but on a long-term basis, far sustainable basis. But investing in equity is not an automatic thing. Markets have no duty to make you wealthy simply because you have put some money to work in the markets. You still have a duty to pick and choose well, select the good businesses, ensure that these are run by people of integrity and competence. You need to ensure that the business has characteristics which can create economic value, and you have to be disciplined and buy these quality franchises at sensible prices, and thereafter having the wisdom to stay the course. So all of these are duties imposed upon investor before he can expect to make those meaningful returns which are embedded, potentially inherent in equity as an asset class. So it's not an automatic that you put money into the equity markets and that's a get rich quick kind of a scheme. It is not. So investors have work to do, and those who are either intellectually lazy or unwilling to really do what are the required tenets for good investing, the results can't be gratifying.
Yeah. All right. So since we now know that equities as an asset class is the place to be, Mr. Shah, you've been a veteran investor yourself. Does the current market standing and the environment that we are in bother you a little bit? I mean, obviously from a long-term point of view, these will just be events that will come and go. But does it present an opportunity, or do you still see more risks?
No, the current events don't bother me a wee bit. If you invest in markets, you must know that the volatility and violence is an alter ego of markets. Not necessarily high amount of violence of the kind that you saw in 2008-9 when markets were torn asunder, but a 15-20% kind of a drop in the markets is something which you should routinely expect every few years, and there is nothing very surprising about it, nothing particularly rabid about it. And volatility in any case on a normal basis would always be there in equity. It was there in the past, it is there today, and it will remain in future. So if you are frightened about volatility, you can't be into the markets, that's for sure. But once you understand that markets are less of weighing machine behavior in the short run and more like voting machine in that short run, but over a long run it behaves more like weighing machine, then you realize actually the beauty and the power of the markets. That the best way to tame the beast is by being disciplined yourself, because otherwise you let the indiscipline of market to become your own indiscipline. So markets on a temporary basis, time to time, will behave in a violent, volatile, unreasonable, exaggerated way. All kinds of things are possible. But over a period of time, markets are calm, serene, quiet, quiet, well behaved, and most importantly, whatever may be the gap between price and the real value of a business at a point of time, over a period of time, price and value invariably are brought together by the magic wand of the markets, and we have to have faith and confidence in that. We must have capability to judge business by business, company by company, the real value of the business, which is both art and science, and having judged the real value of the business with calm and clear confidence, we have to be invested for long run at a sensible price, at some margin of safety, some discount to the value, and then having wisdom to stay the course. But if we do that, the rewards are plentiful. So this kind of sometimes the volatility comes in form of oil price. Sometimes it could be trade conflict between US and maybe China or more parts of the world. Sometimes it comes in form of default by ILFS in CP markets. These events come and go. I don't think we should get carried away or worried too much, because overall broad fundamentals remain solid, compliant, quality businesses. The prices have come down, but the fundamentals, their earnings, their capability remain completely intact. And therefore, I would say this is a fantastic opportunity to buy quality franchises at fair prices.
Right. So in light of that, would you use this volatility and the correction as an opportunity then to get into the equity markets if you were shy of getting in at higher valuations? And also from a slightly more longer term perspective, are you bullish on the India growth story, be it from an earnings point of view, be it from an equity market point of view, and be it from the point of view of the economic growth itself?
Well, the answer to the first question is clearly yes. That of course, this is, to me, it looks like as good a time as ever. If I have to quote Buffett, even after my 30 years of investing, I feel like a kid in a candy shop today. That is the kind of opportunities that I see in the markets. There are a lot of negative naysayers around, a lot of people who get worried by day-to-day events. There are a lot of people who are worried about and will make meaningful noises about this problem and that problem. But I think equity is art of seeing a possible opportunity rather than seeing constant threats. And I see far more opportunities rather than challenges. So the answer to the first question is yes. As far as the second part is concerned, in terms of the longer term picture, the broad fundamentals of the economy remain solid. Even if you look at macro numbers, by and large, I find the picture gratifying. Inflation is reasonable. I'm fairly confident that the fiscal deficit would be at the targeted level of about 3.3 that is out in the budget. Even current account deficit at 2.5% odd is something which is reasonable given the oil price situation that we have gone through. And I think quality firms, quality businesses are reporting very, very robust numbers. Unfortunately, in the media when these data comes out, they had apple, oranges, lemon, cherry, melon, everything put together and come up with an average to arrive at a description of what is happening to the market, and which is fundamentally a very bad and poor way of looking at markets, because those kind of aggregates hide a lot of meaningful reality behind it. What I'm seeing actually is that in virtually all the sectors, in the quality businesses, compliant businesses, straightforward managements, company after company, we are seeing fantastic performance by those businesses, barring a couple of them having produced numbers which are little less than what we expected. By and large, of all the results declared so far, we have been pretty comfortable in terms of the kind of performance rolled out by the firms. So I would go by the reality as we see in the businesses rather than here hear too much of opinion dished out in various forms of media. Because when we listen to these opinions in the media, we think we are seeing one kind of world. When we go and check out with the companies and businesses, we find we seem to be in some other world. And therefore, the opportunity that we see is based on what we think at a ground level exists. So I remain very comfortable, and I believe prices have corrected and are reasonable. Good businesses are getting better. Their performance has been rock solid, and if you are able to disregard the sentimental backlash that the markets produce when markets are not exactly very conducive, that is exactly the best time when you can make easily good returns by just buying good companies at a sensible price and remaining there, which is what I see today. And on a more longer term basis, I believe probably the best decade for India, its economy and its quality and compliant businesses, probably the best decade ahead is going to be now. That's what I personally strongly believe.
Mr. Shah, your take on the current turmoil in the NBFC space, and how have you read into the situation?
I think it is a very good thing that has happened. Lot of NBFCs have been indisciplined. Many of them have poor quality assets. Many of them were reckless to have improper asset liability match. Many of them were in anxiety to grow, were lending at rates which were not sensible, and in any case many of them were lending to poor quality borrowers, and therefore time to time rude reminders like these sorts out the boys from the men. And therefore, all that has happened in the NBFC and some of the concerns that the firms are going through is actually healthy and good for the quality firms, disciplined firms, firms which understand that lending, it is easy to lend, but the real work happens only when you have recovered what you have lent. And therefore, the quality firms are disciplined in the lending rates, in the client profile, in the way they go about it, in their leveraging, and in managing their overall operations in a tight, proper fashion, which is what a lending business is all about. And therefore, all that has happened will eventually ensure a greater hygiene, strength, and actually greater respect and regard for better behaved, disciplined, quality NBFCs. So all what has happened, in my opinion, is very good.
Is that an investment category that people should look into now?
We have done it in the past, we have done it today, and we'll look forward to doing that in future.
Right. One last question, Mr. Shah, before I wrap this up. While you've been talking about using opportunities and using the market volatility and dips like this as an opportunity to start, building up the portfolio, which direction, which areas to focus on right now? Probably areas which are under-owned so far and have growth potential, or areas which are over-owned but the valuations were lofty and now they've started to come off. So which segments are you focusing on?
I think more from a bottom-up stock picking point of view. But having said that, clearly consumption, both durables, non-durables, is a fantastic opportunity. In $2.5 trillion GDP last year, almost 1.6 trillion was consumption, which is nothing. Only when this consumption from 1.6 will become 5, 8, 10, 12, that I'll probably start reflecting whether there is any further scope for it to grow. Till then, I think in my opinion, on a long run, there is a free highway there. On the banks, quality NBFC, quality insurance firms, again, there is a great long-term opportunity. Finance sector in general is a force multiplier. It usually grows at a multiple of GDP growth rate, and typically the growth rate of finance precedes that of the economy. And therefore, it always remains a very attractive and major area. But we have to act with discipline and find the right quality businesses run by quality managements. So NBFCs, quality banks, and the quality insurance firms, all of them represent great opportunity. Similarly, in automobile, auto parts, automobile, we have a critical ecosystem, whether we take two-wheelers, scooters, bikes, commercial vehicle, three-wheelers, cars, we are among the top largest to anywhere within first 5 ranks in the world in each of these categories, and therefore we have a great critical mass both from a domestic market as well as international opportunity. Along with that, auto parts opportunity, which again is a significant one. Agriculture related, where important fundamental changes are brewing around, and over a period of next 5 to 10 years will witness more important significant changes. Therefore, quality agriculture dependent businesses will do wonderfully well. So these are some areas, but as I said, we don't invest based on economic macros. I don't think that global macros can have an unduly major impact beyond a point. It is not even buying of the themes or sectors. It is at the end of the day buying individual business for its merits or lack of it.
Got that. Mr. Shah, it was a pleasure chatting with you, sir. Thanks very much for joining us. Appreciate you taking out the time and sharing your thoughts with us here on the show.
Thank you very much, David.